Hello class. Today we will be understanding a very important concept in financial management. That is WACC. It stands for Weighted Average Cost of Capital. It represents the average rate a company is expected to pay to finance its assets, weighted according to the proportion of debt and equity in its capital structure. Think of it as the blended cost of the company's financing debt and equity.
But what are debt and equity?
Debt is borrowed money. The company takes loans or issues bonds and agrees to pay interest and repay the principal. It's like renting money. Equity is ownership. The company raises money by issuing shares, giving investors a piece of the company in return for capital. Equity investors expect returns in the form of dividends and stock price growth.
When do companies use or select between debt or equity?
Companies may use debt when interest rates are low or when they want to retain control because debt doesn't dilute ownership. They may use equity if they don't want to add repayment pressure or if they're already heavily in debt. Key point: the mix of debt and equity affects risk, control, and cost of capital, and that's exactly what weighted average cost of capital captures. Here is the formula for weighted average cost of capital, where E is equal to market value of equity, D is equal to market value of debt, V is equal to total value, that is market value of equity plus market value of debt. RE, or the cost of equity, is the return that equity investors require on their investment in the company. RD, or the cost of debt, is the effective interest rate a company pays on its borrowings. TC is equal to corporate tax rate. It reduces the effective cost of debt since interest payments are tax deductible. Let's consider an example to illustrate this. Let's say a company has $60 million in equity, $40 million in debt. Cost of equity is 10%, cost of debt is 6%, corporate tax rate is 30%. First, calculate total value, that is value of equity plus value of debt, as $60 million plus $40 million, which gives us total value as $100 million. Then plug in all the values in WACC formula that gives us WACC as 7.68%. Why is WACC important? It's the hurdle rate for investment decisions. If a project's return is above the weighted average cost of capital, it creates value. If it's below, it destroys value. Rule of thumb: only invest in projects where return is greater than weighted average cost of capital. Lower weighted average cost of capital is equal to cheaper capital, which means higher valuation. Higher weighted average cost of capital is equal to more expensive capital, which means riskier or inefficient capital use. So, that's weighted average cost of capital, your company's true cost of capital. Understanding it helps you evaluate investments, set fair discount rates, and maximize shareholder value. WACC is not just a formula, it's a financial compass. If you found this helpful, don't forget to like, share, and subscribe for more clear and simple finance videos. See you in the next one.